because if we're in for that kind of period, gold will be fine. If you bought it here and it comes off a couple $100, I understand that. Don't sell it though. I mean, look up, next 5 years and maybe it's 4,000. But so I don't buy into that idea that, hey, because now we're in a period that we've never been in a period in a long, long time, Kai, where all these foreign governments that are buying gold, they do not want the dollar. And they keep on buying gold. Then they see this trade, for example, oil, gold, dollar. Okay. And I think what they're trying to do is say, we want to get to a point where we can hedge all of that, and gold is what we're going to do it with. And that's going to be our new, maybe, world reserve. I'm talking about country by country now.
In a bold forecast that has captured investors' attention worldwide, TedOakley, founder and managing partner of Oxbow Advisors, predicts a golden future for the precious metal. Oakley, whose wealth management firm caters to high net worth clients, believes gold could reach a staggering $4,000 per ounce within 5 years. Oakley's optimistic outlook isn't isolated. It aligns closely with the current sentiment among major Wall Street institutions, which are revising their gold price targets upward. Financial giants are betting on gold as global tensions rise, particularly in the Middle East. Goldman Sachs has set a bullish target of $2,700, while Bank of America anticipates $3,000. From a technical perspective, this momentum paves the way for gold to surge to $3,000 an ounce in 2024, possibly hitting $4,000 even sooner. As interest rate hikes and recession fears continue to drive market volatility, gold remains a strong hedge against uncertainty, reinforcing Oakley's long-term outlook and the forecasts from these financial institutions. Delving deeper into the geopolitical landscape driving this gold rush, Oakley elaborates, many foreign governments are buying gold to reduce their dependence on the US dollar. They recognize the trade relationships between oil, gold, and the dollar, and are increasing their gold reserves to hedge their risks. This shift is particularly pronounced among certain nations, with Russia and China together accounting for more than 80% of the net central bank gold demand reported to the International Monetary Fund since 2004. As central banks ramp up their gold purchases to over 1,000 tons per year in 2022 and 2023, the market is beginning to recognize the importance of their contributions to gold demand. Before watching this video, please subscribe to our channel, hit the bell icon, and share it with your friends.
I think if you buy gold, you have to think of gold like this. At any time you buy it, it could correct, 10 or 15%. But if you're buying it for the long haul, and I say, the next 3 or 4 years, you could buy it now. Yeah. Maybe you don't buy as much as you normally would, but you could certainly buy it. I think the investing public and even the pros are very, very uninvested in gold and gold miners. I know they've moved, but I think they're very underinvested, so that when they finally catch on, a la like a 2011, these prices and gold price too could be much, much higher than people are thinking right now. And maybe it's not, but if you look at gold over time, you have to think about it this way. If I own it, I'm going to own it for a long time, because you will go through periods where you'll have 3 or 4 years where nothing happened. Maybe it goes down. But on the long run, you go back and look at the number one performing asset since January 1 of 2000 over the S&P and anything else, gold. Now, people say, yeah, but I didn't make any money between 11 and 16. No, I understand. But you also didn't make any money in the S&P between 2000 and 2012. So which one do you want, And I'm not saying you put the whole portfolio in gold, but if you see the next 10 years under what we think will be, we've been saying this all along, it'll be different. And a lot of pros in my business don't know how to handle this, and they won't know how to trade. You're going to have to trade bonds. You're going to have to own commodities, some commodities, have to own some gold. And I think if you've got to have that in your portfolio, if you're going to have a good mix, and you can't just pin on these 7 or 8 stocks, because if we're in for that kind of period, gold will be fine. If you bought it here and it comes off a couple $100, I understand that. Don't sell it though. I mean, because you could look up, next 5 years and maybe it's 4,000. But so I don't buy into that idea that, hey, because we've never been in a period in a long, long time, Kai, where all these foreign governments that are buying gold, they do not want the dollar. And they keep on buying gold. Then they see this trade, for example, oil, gold, dollar. Okay. And I think what they're trying to do is say, we want to get to a point where we can hedge all of that, and gold is what we're going to do it with. And that's going to be our new, maybe, world reserve. I'm talking about country by country now, but you just see they keep on buying it. And if in the public, our public and investment managers, they're totally underweight gold and gold miners. They own very little of it. I think it's just a steady rise based on what's going on with trade and the countries. Again, if these countries could snap their fingers tomorrow, these top 11 or 12 countries that really have been buying all the gold, they would love to have a currency that they could use that was backed by gold, that they could trade everything with. And they understand what's going on with the dollar, and they understand what the U.S. government is doing. You know, they're going to run themselves ragged by this debt, and there's no good end to it. And so I think that's why they look at the thing the way they do right now.
The dollar is expected to keep falling, leading to higher costs across the board in a stagflation environment, Oakley cautions. His prediction carries significant weight, particularly considering the United States' heavy reliance on imports. Recent market developments align with Oakley's forecast. The Federal Reserve's latest monetary policy decision has sent ripples through the currency markets. In a move that surprised many, the Fed implemented a supersized 50 basis point interest rate cut and shifted to an easing monetary policy stance. The reaction was swift, with the U.S. dollar slipping in choppy trading as investors scrambled to digest the news. Oakley points out a silver lining for investors. He highlights that the current situation offers a unique advantage. Yields on floating rate treasuries are around 1.6% to 1.7% higher than the inflation rate. This scenario creates an attractive investment opportunity for those looking to stay ahead of inflationary pressures. This favorable yield environment coincides with recent movements in U.S. Treasury yields. The 10-year Treasury yield has dipped slightly, reflecting investor reactions to recent inflation data and its potential implications for Federal Reserve policy. Meanwhile, the 2-year Treasury yield has risen, indicating a mixed market sentiment as investors assess inflation risks and interest rate expectations. Let's get back to the video.
The dollar is falling, and I think it would continue to fall. So if you're in this stagflation mode and the dollar's falling, that means that everything we're buying is going to be higher. So you look at everything, and we import a lot of things, and a lot of things would go up. And I'm not talking about just at the consumer level, but I'm talking about at the manufacturing level. And you look at a lot of things that we bring in are going to go up in price because the dollar goes down. And those countries are not as worried about it, Kai, because they keep on buying gold as the hedge. They're not as worried about the dollar now as they would have been. You know, they used to be tied to it a lot. They're trying to get away from it. So it's an interesting situation right now. The dollar going down, gold going up, and they're buying more gold. And so the prices they're pushing into us, are going to be higher for us. And so I think that's where it starts now. The other side of that is if you look at the commodity price relative to, say, the S&P 500, the S&P commodity index, it's all-time low. You don't have to have a lot right now. I mean, you can have things start to move up, and it'll be like the 70s. I know I was around then, but a lot of people don't realize that in the 70s, it threw everybody off because you couldn't buy long bonds, commodities went up, the markets just stayed in a trading range, and that's sort of what it came out of that. Then you had gold go up, a lot of things happened, but I think that's what people are missing here. If the dollar keeps on sliding, your prices are going up. And then, I don't know this would happen, but it could happen if you keep having all of this thing going on war-wise in the Mideast, and if oil goes that much higher, let's say above 3% of GDP, 3.5%, then you're in trouble. And I think that's what people forget to see in all of this. And they think, well, the Fed will take care of it. Well, there's a lot of things they can't take care of. And that's why I think the inflation piece will come back in eventually. Maybe it doesn't this month or next month, but I think eventually it gets back. That's why we have a lot of things in that category. Where I think people are probably wrong on this, Kai, is that you could easily see, and I think you will see, asset pricing and inflation continue higher, say December, January, first quarter next year. And then what does the Fed do? When inflation, ticks back up, and now they're in this idea that, hey, we're going to lower. And I think the lowering has to do with they've got to finance these U.S. deficits, and also the bonds that are, $15 trillion in bonds coming due the next 3 years for our federal government. That's at a rate of about 2.3%. And if they had to put it out today, it'd be 5%. So, it'd be a tremendous cost. So there's a lot of things, working in here, and it's hard to see how they come out. But I do think it ends up being, and I've said this before, we said this the last 2 years, that we felt like the next 10 years it's going to be like it was in the 70s and early 80s, which will be sort of a stagflation. I don't think the Fed will know how to operate in that environment, but we'll find out. Right now they look great. We're going to soft land it and everything will be fine. But real rates, if you subtract the inflation rate, from the interest rates, are still high. They're still too high. So what should happen is, and you'll just have to see this, you'll have to see if they follow that. But if they follow it down, then you have to remember inflation can rear its head again. And I think that's what will throw them the next 6 or 9 months. We have still quite a bit in the floating rate Treasury, which prices off of the 90-day every Monday. So it prices off of the 3-month high. But what happens is on that is that if you look at the inflation rate, just take the inflation rate, you're still almost 1.6, 1.7% above the inflation rate. And that's usually not that way. So it's not like you're giving up anything by the rates coming off. Instead of paying 5.25 now, 4.75. You're still well ahead of inflation, and that's the name of this game. I mean, you got to stay ahead of inflation.
As global economic dynamics shift, gold emerges as a focal point for investors, central banks, and nations seeking stability in uncertain times. The Federal Reserve's unexpected shift to a more dovish stance and concerns about a weakening dollar paint a complex picture of the economic landscape. As inflation fears loom and the specter of stagflation haunts market projections, gold's traditional role as a hedge against uncertainty gains renewed significance. Do you think we'll see that $4,000 per ounce mark anytime soon? Share your thoughts in the comment below. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell to stay up to date with the latest financial insights.